They were hoping for a tranquil holiday. Financial institutions on Wall Street were eager to conclude their business for the day. Their wish was to finalize their ledgers, enjoy some seasonal beverages, and put the silver market out of their minds until the new year. However, the market had a different trajectory in store. Today is Wednesday, the 24th of December, marking Christmas Eve. Typically, this is the quietest trading day of the entire year. Transaction volumes are minimal, trading desks are sparsely populated, and virtually nothing of consequence transpires. Yet on this particular day, everything unfolded. Observe your trading monitor. Silver is currently priced at $72.42. This represents an increase of nearly $4 within a single trading session, a surge exceeding 5.6%. This is not merely a rebound, it is a capitulation. This is the audible signal of commercial banks conceding defeat. They attempted to maintain a ceiling at $70 and they were unsuccessful. Their subsequent effort to preserve the $71 level also proved futile. Now, mere hours before the market's holiday closure, they are engaging in desperate purchasing of every available asset to neutralize their positions before Christmas. And the surge is not confined to silver. Gold has officially breached the $4,500 mark. The prevailing currency is fracturing, the mechanisms of price suppression are disintegrating, and you are a witness to the most significant redistribution of wealth in recorded history unfolding in real time. Within this urgent holiday market update, we will meticulously dissect the events that have just transpired. We will elucidate the reasons behind the bank's forced liquidation of their short positions on this specific day. Furthermore, we will analyze the signal emanating from gold, explaining why gold reaching $4,500 necessitates an upward trajectory for silver. Finally, we will outline our expectations for when the markets resume operations following the Christmas holiday. The opportune moment has arrived, the price is $72.42, and the intense pressure is only just commencing. Why did this occur today? Why would the price experience such an acceleration on Christmas Eve, a time when trading activity is expected to be virtually non-existent? The answer lies in risk management. Envision yourself as a risk manager within a prominent financial institution. You hold a substantial short position encompassing millions of ounces of silver. The price surpassed $70 only yesterday, placing you at a financial disadvantage. Now you are confronted with a holiday period during which the markets will be inaccessible. However, the world continues its operations, unforeseen news can emerge, geopolitical incidents can occur, and supply chains can fracture. If you enter the Christmas recess burdened by a significant short position and adverse developments materialize, you could awaken on Friday morning facing insolvency. The inherent risk is simply too formidable. Consequently, the risk manager would approach the trader and issue a directive: secure our exit. The current price is secondary. My priority is to be entirely out of this position for the Christmas break. This constitutes a forced liquidation. Their motive for purchasing is not a newfound appreciation for silver, but rather profound apprehension regarding holding a short position while the market is closed. This surge in buying pressure encounters a thinly traded market, propelling the price upwards with astonishing speed. We observed a vertical ascent from $69 directly to $72.42. This is the air pocket we previously discussed. There were no sellers present, only desperate financial entities endeavoring to escape before the holiday closure. We must address the most prominent issue: gold. In our preceding communications, there existed some ambiguity concerning the price of gold. Let us clarify this matter definitively at this juncture. Gold is trading at $4,499.96, effectively $4,500. This serves as the definitive signal. Gold functions as the central regulator of the financial system. When gold achieves the $4,500 level, it communicates a significant erosion of the dollar's purchasing power. It indicates a collapse in confidence in fiat currencies. Now direct your attention to silver. Silver is currently trading at $72.42. Let us perform the calculation. The gold to silver ratio derived by dividing $4,500 by 72.42, yields approximately 62. Historically, this ratio has been considerably lower. In 1980, it stood at 17. In 2011, it was 30. Even at $72, silver remains undervalued in comparison to gold. If the ratio were to revert to its mean of 30, with gold remaining at $4,500, silver would need to reach $150. This is the rationale behind the algorithmic trading algorithms increasing their silver holdings today. They perceive gold's breakout and recognize silver's lagging performance, prompting a corrective buying action. The movement to $72.42 is merely the elastic band snapping back into place. Silver is endeavoring to re-establish its intrinsic value in relation to its more prominent counterpart. How can we ascertain that this is a short squeeze rather than organic buying activity? The velocity of the price movement. Organic buying typically manifests as a gradual upward grind. A short squeeze, conversely, is characterized by its ferocity, achieving a 5% increase within a single day. When silver experiences a 5 6/10% appreciation in one session, it bears the mathematical imprint of short covering. This signifies that those who were positioned for a decline are now becoming purchasers, effectively funding the gains of those who were betting against them. This represents a critical juncture for the banking institutions. If they were unable to arrest the price at $70 and subsequently failed to contain it at $72, what is the ultimate ceiling? Is it $75? Is it $80? The most disadvantageous scenario for the shorts is a further price increase. The higher the price ascends, the greater the pressure on the remaining short positions. The amplified distress compels them to purchase more aggressively, creating a self-reinforcing cycle. Currently, this cycle is escalating beyond control. $72.42. This single figure alters the entire landscape. It shatters the $70 barrier, which had served as a psychological impediment for numerous investors. With the price now firmly established in the 70s, the market's attention will inevitably shift towards $80. $80 represents a mere 10% increase. In a market experiencing daily gains of 5%, we could reach $80 as early as next week. This development will attract momentum traders, investment funds that exclusively acquire assets demonstrating upward price action. They will observe the chart patterns, the breakout signals, and the trading volumes, and subsequently enter the market in large numbers. We are transitioning from a contrarian investment strategy to a momentum-driven approach. This signifies the onset of a speculative frenzy. While it may be unsettling and volatile, it presents substantial profit potential for those already holding relevant positions. Consequently, the banking institutions have capitulated for the day. The price stands at $72.42, but the holiday has just commenced. In the subsequent segment, we will examine the liquidity vacuum. We will explain why the days between Christmas and New Year's are historically among the most perilous and volatile trading periods of the year. We will investigate the constricted order books that permit prices to gap upwards by $10 overnight. Furthermore, we will discuss the tangible disconnect currently occurring with bullion dealers. While the paper price stands at $72, can one actually procure physical metal, or have the dealers shuttered their operations for the holidays to safeguard their inventories? The price pressure has not subsided, it has merely taken a Christmas recess. We are now entering a period of reduced market participation. For those just joining us, let us review the current standings. The contest on Christmas Eve has concluded. The financial institutions have retreated. The price of silver is cemented at $72.42. Gold is positioned at the significant benchmark of $4,500. The optimistic investors have secured the week. However, we are now entering a highly peculiar and potentially hazardous temporal phase. Traders refer to this as the ghost week, the interval between Christmas Day and New Year's Day. The prevailing assumption is that the markets enter a dormant state during this period, with no significant activity until January. This assumption is incorrect. Some of the most dramatic and explosive financial movements in history have occurred during this precise week. The reason for this phenomenon is the absence of senior decision makers. Risk managers are on holiday, liquidity providers are offline, and trading volumes are significantly diminished. In the subsequent segment, we will delve into the liquidity vacuum. I will demonstrate how illiquid markets create the ideal conditions for substantial price surges. We will examine the current shutdown of dealer operations. You will understand why it is virtually impossible to purchase physical silver at the prevailing market price anywhere in America this weekend. Additionally, we will discuss the risk of a Sunday night gap, which occurs when the Asian markets emerge from their Christmas observance before our own. The price is elevated and the trading volume is low, a potent recipe for significant market fluctuations. Let us now enter this void. To comprehend the critical nature of the forthcoming days, it is essential to understand the concept of liquidity. Visualize a packed football stadium. If a single individual shouts, their voice will be lost amidst the collective din. This is akin to a liquid market. It requires billions of dollars to influence the price because of the sheer volume of buyers and sellers. Now, imagine an empty gymnasium. If one person shouts, the sound will reverberate and be overwhelmingly loud. This represents an illiquid market, the very environment we are currently navigating. For the ensuing week, major financial institutions will operate with minimal staffing. The order book, a record of pending buy and sell orders, will be exceedingly sparse. Instead of 500 contracts available at $73, there might be only 50. Consequently, what transpires if a substantial buyer emerges? What if a Japanese pension fund decides to acquire silver on December 26th? They submit a market order. This order will instantly consume the available 50 contracts. Subsequently, they will encounter the next price level and the next, as there are insufficient sellers to impede their progress. The price will then surge dramatically. We could witness silver jump from $72 to $75 within minutes, not due to any specific news event, but simply because there was no one present to offer resistance. This is the holiday squeeze, the mechanism by which prices gradually escalate on low trading volumes. It creates a deceptive trend that catches market participants off guard upon their return in January. While the paper market is experiencing low liquidity, the physical market is effectively closed. Visit the website of your preferred bullion dealer at this moment. You will likely encounter one of two scenarios: either sold-out banners or notices indicating holiday delays. They will attribute this to Christmas. While true, this is not the complete explanation. The actual reason for their operational pause is risk mitigation. A bullion dealer operates on very narrow profit margins. Upon selling a coin, they immediately hedge their position or replenish their inventory. However, during the Christmas weekend, the hedging market is inactive and wholesale suppliers are also closed. If they were to sell you a monster box of Eagles today at $75 and the price were to surge to $80 on Sunday night, they would be unable to procure replacements. This would result in substantial capital losses. Therefore, the prudent business decision is to cease sales. They withdraw their inventory, mark it as unavailable, and await the 2nd of January to assess the market's settled price. This effectively creates a physical lockout. You possess the funds, you desire silver, but you are unable to acquire it. The asking price has vanished. This is the ultimate indicator of a squeeze. When you are incapable of exchanging your fiat currency for precious metal at any price, it signifies a fundamental breakdown of that currency. If you have already secured your holdings, congratulations. However, if you intended to make a purchase this weekend, you may be out of luck until silver reaches $80. An additional factor driving prices upward is the calendar. January historically represents the strongest month for precious metals. This is due to the commencement of new budget allocations. Industrial enterprises finalize their purchasing budgets for the year. Investment funds receive their new capital allocations. Traders are well aware of this phenomenon. They anticipate that on January 2nd, a substantial influx of capital will enter the market. Consequently, what action do they take? They engage in front-running. They purchase assets in late December, intending to sell them to new buyers in January. This proactive strategy transforms the final week of December into a competitive race. No one desires to hold a short position heading into January. No one wishes to bet against the newly allocated capital for the year. Therefore, The path of least resistance is upwards. With silver trading at $72.42, traders are now targeting $75 as the year-end closing price. Their objective is to enhance the chart's appearance, aiming for silver to be the best performing asset of 2025, a goal they are very close to achieving. Now we must address the inherent risks. Although the markets are closed for the holiday, the global economy continues to function. We are observing gold trading at $4,500. This represents a significant psychological threshold. If gold decisively surpasses $4,500 and climbs to $4,600 over the weekend, silver's reaction will be exceptionally pronounced. When the futures market reopens on Sunday night, we could witness a substantial upward gap. The pent-up pressure accumulated over the extended holiday weekend will be unleashed simultaneously. Short positions maintained throughout the Christmas period will be liquidated instantaneously. This underscores the peril of being under-allocated. If you divested your holdings at $70, anticipating a price correction, and the market subsequently gaps to $74, you will be left behind, unable to participate in the upward movement. This is why the hold strategy is the sole secure approach during a speculative frenzy. You must be actively involved when the momentum builds. Thus, liquidity has evaporated, dealers are closed, and traders are anticipating January. But what about the actual purchasers? What about the manufacturing facilities? We have previously discussed entities like Samsung and their involvement in battery technology. However, our focus must now shift to year-end procurement for companies such as Tesla and First Solar, which need to secure their Q1 inventory. With the price rapidly approaching $72, they are experiencing considerable apprehension. I will explain why industrial buyers are likely currently negotiating bespoke off-market agreements, desperately seeking to secure supply for January. Furthermore, we will examine the mining stocks. With silver trading at $72, mining companies are generating unprecedented profits. We will investigate why the mining sector may represent the next significant catch-up trade. The holiday may be quiet, but the underlying panic is palpable. Stay tuned for Part 3. We are now returning to the operational level of the industrial sector. For those who have just tuned in, the financial world has just experienced a Christmas surprise. The banking institutions have capitulated. The price of silver is $72.42. Gold stands at $4,500. We have discussed the traders and the bullion dealers. Now, it is imperative to address the individuals and entities who are the actual end users of this precious metal, the industrial titans such as Tesla, Samsung, and Ryans. For them, this price surge is not merely a graphical representation on a chart, it signifies a budgetary crisis. Imagine being the chief financial officer of a major solar panel manufacturer. You formulated your budget for 2026, operating under the assumption that silver would be priced at $50. Today, it is $72. Your operational expenses have abruptly escalated, your profit margins have plummeted, and you are responsible for maintaining production at your facility in January. In Part 3, we will investigate the industrial panic. We will elucidate the reasons why companies are scrambling to finalize off-market agreements at this precise moment, driven by a desperate need to secure supply before the price reaches $100. Additionally, we will analyze the other side of this market dynamic, the mining companies. At $72 per ounce, silver miners are generating more revenue than at any point in their historical existence. Despite this, their stock valuations have not yet reflected this surge. The era of manipulated paper markets is drawing to a close, and the tangible industrial realities are beginning to take hold. Let us now enter the boardroom. It is the 24th of December. Corporate procurement departments are typically dormant at this time. However, this year, the telephones are ringing incessantly. Industrial buyers operate on quarterly fiscal cycles and require secured inventory for the first quarter. Ordinarily, they would utilize futures contracts to hedge against price fluctuations. However, as previously discussed, the futures market is currently compromised, exhibiting volatility and inherent risk. Consequently, they are compelled to engage with the physical market. They are contacting refiners and stating, We require 10 metric tons of silver paste to be delivered on January 2nd. The refiner consults the prevailing market data. The price is $72.42 plus applicable premiums. The buyer expresses dismay but proceeds with the transaction. Why do they agree to these terms? It is due to the fear of supply shortages. If they were to delay their purchase until next week and silver were to gap to $75, they would be perceived as incompetent. If they postpone their acquisition until January and no silver is available, their positions could be jeopardized. Therefore, they are accelerating their orders, purchasing now to safeguard their professional standing. This represents substantial inelastic demand entering a market devoid of liquidity. It functions like a vacuum cleaner, absorbing every available bar before the year concludes. Now let us consider the beneficiaries, the mining companies. Let us perform some calculations. For a primary silver miner, the cost of extracting 1 ounce of silver from the earth is approximately $20. Yesterday, they were selling it for $60, yielding a profit of $40. Today, they are selling it for $72, resulting in a profit of $52. Their extraction costs have not increased overnight, but their revenue has seen a significant boost. This additional $12 per ounce flows directly to their bottom line, representing pure free cash flow. At these price levels, mining companies are generating capital at a pace that rivals the Federal Reserve. They are debt-free, flush with cash, and distributing dividends. However, observe their stock prices. Have they tripled? No, they have certainly appreciated, but they are lagging behind the performance of the metal itself. This presents the catch-up trade opportunity. Wall Street is slow to react, skeptical that the silver price will remain at these elevated levels, viewing it as a temporary spike. However, once they acknowledge that $72 represents the new baseline, they will enthusiastically invest in mining stocks. It is plausible that the mining index could double within a month as investors chase this burgeoning cash flow. If you possess the physical metal, you are secure. If you own mining stocks, you possess leverage, and currently that leverage is working in your favor. A clandestine market is emerging. While the public price of silver is $72.42, significant transactions are occurring away from the public exchanges. A battery manufacturer approaches a mine in Mexico and proposes, "We will acquire your entire production for 2028. We will offer you a fixed price of $75. The miner agrees, securing a substantial profit. The battery manufacturer also agrees, guaranteeing their supply. What is the impact of this on the market? It removes silver from the public exchange, meaning that this metal will never reach the vaults in London or New York. It will proceed directly from the mine to the factory. This diminishes the observable inventory. The COMEX warehouses will continue to deplete even if the price increases because the metal is being intercepted at its origin. This is the reason why the short squeeze will not conclude swiftly. The short sellers are unable to cover their positions because the metal never reaches the designated warehouses. It is being commandeered by industry. We are witnessing a fundamental shift in how corporations perceive their balance sheets. For 2 decades, companies prioritized holding cash, considering it paramount. Now cash is increasingly viewed as a liability as its value diminishes. Silver, conversely, is an asset that appreciates in value. Chief financial officers are beginning to question whether they should maintain strategic reserves of raw materials. If Apple holds $1 billion in cash, its purchasing power erodes. However, if Apple holds $1 billion in silver, it secures the production of iPhones for an entire year. We are transitioning from just-in-time inventory management to strategic stockpiling. This trend is in its nascent stages. When major corporations begin to regard silver as a treasury asset, the demand will be measured in billions of ounces, not millions, and there is simply not enough silver to satisfy widespread hoarding. Consequently, the industrial sector is in a state of panic, the miners are prosperous, and the supply is rapidly vanishing. We are approaching the final week of the year with silver at unprecedented highs. What lies ahead? What will transpire when the calendar transitions to 2026? In Part 4, the concluding segment of this series, I will present the endgame roadmap. I will identify the technical targets for the first week of January. I will explain the dynamics of tax loss selling, which may present one final buying opportunity before the new year, and I will offer you my definitive advice on how to manage your emotions when your portfolio is experiencing explosive growth. The capitulation is complete and victory is within reach, but the struggle for wealth preservation is perpetual. We are now looking towards the forthcoming year. We have reached the conclusion of this emergency broadcast. The Christmas Eve markets are closing. The price of silver is indelibly marked in history at $72.42. The banks have surrendered, the industrial sector has panicked, and the price has soared. However, as investors, we must not dwell on the past. Our focus must be on the future. We are 1 week away from a new year, 2026, and the conditions being established for January are unlike anything we have witnessed previously. In this final chapter, Part 4, I will provide you with the endgame roadmap. I will explain the January effect, detailing why the first week of the year historically witnesses the most significant price surges in precious metals. I will caution you about one final potential pitfall: tax loss selling. And I will equip you with a strategy to navigate the transition from a price squeeze to a sustained supercycle. The year is concluding with a dramatic flourish, but the new year will commence with an even greater impact. Let us conclude this analysis. Why is January of such critical importance? Because the financial world initiates a reset. Every fund manager, every pension fund, and every asset allocator begins with a clean slate on January 1st. They receive new capital infusions from investors and rebalance their portfolios. Imagine you are a fund manager. You have just witnessed silver generate a 50% return within a single month, yet you hold zero silver. Your clients are contacting you, demanding an explanation for why you missed this opportunity. What action do you take on January 2nd? You purchase. You are compelled to do so. You require exposure to this asset. This generates a substantial influx of new capital into the market during the first week of the year. They are buying the previous year's winners in pursuit of enhanced performance, and currently, silver stands as the undisputed victor. This January effect frequently propels prices considerably higher. Therefore, if you believe $72 represents the peak, merely await the point when pension funds begin allocating just 0.1% of their assets to silver. That seemingly small percentage translates into billions of dollars. This will impact a market that is already experiencing a depletion of supply. However, before we reach January, we must navigate the final days of December. There exists a phenomenon known as tax loss selling. Typically, investors liquidate their underperforming assets at the year's end to offset capital gains for tax purposes. However, in a year where most assets have appreciated, individuals sometimes sell their winning positions. Why? To realize their gains, cover Christmas expenses, or rebalance their portfolios. Alternatively, equities tied to the mining sector that have lagged might be divested by investment funds engaged in year-end portfolio adjustments. This scenario could foster an unusual market condition. In the period between Christmas and New Year's Eve, we may witness considerable price fluctuations. A sudden decline in mining stocks or a sharp retracement in silver prices to $70 is a possibility. This should not be perceived as a market collapse. Instead, consider it an accounting maneuver. It is merely capital reallocating for fiscal purposes, bearing no relation to underlying economic indicators. Should you observe a downturn in the coming days, it is likely your final chance to acquire assets before the commencement of January investment inflows. Be prepared. Any dip encountered will be brief and swiftly absorbed. Therefore, what is the recommended approach for navigating the transition into the year 2026? Maintain your current holdings. The most challenging aspect of participating in a bullish market is remaining steadfast. You will be inclined to trade actively, to enter and exit positions frequently, attempting to capitalize on temporary price drops for tax purposes. Resist this urge. Doing so risks relinquishing your established stake. You might sell at $71, only to observe the price surge to $75 while you are not actively monitoring it. The prevailing upward trend is robust. Fundamental economic drivers are gaining strength. Technical indicators are providing corroboration. There is no compelling justification for selling. If your investment portfolio is fully allocated, take pleasure in the holiday season. Disregard market fluctuations. Dedicate time to your family. Your preparatory efforts have been completed. The market is now working in your favor. I urge you to take a moment to acknowledge this achievement. For many years, the silver investment community faced ridicule. We were informed that silver held no future value, that financial institutions would never permit its price appreciation. We were subjected to a campaign of misinformation. Today, observing the price at $72, your perspective is validated. You were correct. The calculations were sound. The financial institutions were mistaken. This is not solely a financial triumph. It represents a psychological victory. It demonstrates that competitive markets ultimately overcome deliberate interference. Draw strength from this realization. Utilize this newfound confidence to endure the subsequent phase of this journey, as $72 is not the ultimate target. It is merely the initial stopping point en route to its rightful valuation. Consequently, here is the conclusion. The year 2025 marked the commencement of the significant price movement. The year 2026 will be the pivotal year for silver. We are entering the new year with substantial momentum, supply constraints, and a compromised financial system. The circumstances are ideal. The event on Christmas Eve served as the definitive indicator that bearish positions have been neutralized. The January phenomenon will signify that bullish sentiment has taken control. Be ready. The subsequent 12 months promise to be extraordinary, and you are positioned to witness it firsthand. Continue accumulating assets. Subscribe.